All right. Give me a second to get everybody invited in. And then we're gonna go ahead and we're gonna rock from there. Un momento, por favor. As you can see, we got that countdown going. As you can see, we got that countdown. All right. All invites have been sent. We'll give at least the first few people an opportunity to get in. Let's see if they're paying attention. That's the question. The biggest question is, are they paying attention? Yeah, that's right. I said it. Are they up, about, and paying attention? Good morning, good morning, good morning, Anisha. Good morning. That keeps my word. That keeps my word. Morning, Cecily. I see you, I see you. What's going on, guys? So I guess one of the first things I want to talk about this morning is having a morning routine, right? It's one of the first things I want to talk about this morning. Having a morning routine. Um, so it took me, I want to say about 10 minutes to get everything um, lined up as far as my thought process and everything like that. Big part of the reason it didn't take so long is because it's a routine. It's something that I'm gonna do. If I went through 100 mornings, it's something that I'm gonna do 90 out of 100 mornings. Right? I may miss 1 out of 10 days or something like that, and usually that's a Friday. Usually, and I'll tell you why it's a Friday. Usually it's a Friday because by that time everything we we can know, we usually already know by then. That's one. And then number two, the economic calendar is usually a little dry. Look at Friday. Look at Friday. Look at this. You got one thing on your list for Friday, right? So the economic calendar is usually a little dry on Fridays. And also the newsletters that I receive are usually all summaries of the week, right? And I don't need a summary of the week. I have a summary of the week already. So I'm fine. I'm fine with that. I'm fine with what I've got. You know what I'm saying? Um, so now let's talk about what's coming up today. All right. Latest probabilities of the Fed rate move. We're going to talk about that. As you can see, the next FOMC meeting is in 5 hours and 51 minutes. 5 hours and 51 minutes. So on these days, I'll usually come over here. I'll see what the probabilities are um, of a move today. And I'll also look towards some of the probabilities in the future just to get an idea of what that looks like. All right. So as you can see, 4.25 to 4.5. That is our current set range for interest rates. It's a 99% chance that we will not, I repeat, will not change those rates today. Okay? There's a 99% chance we will not change those rates today. All right, so let's mark that off right now. Let's mark that off right now. There's a 99% chance of no rate change. So how we look at this is, there's always an interpretation to be had. Okay, there is always an interpretation to be had. How we look at this is simple. All right. Yeah, I'm marking off my notes exactly. I'm marking off my notes. Well, no, I'm sorry. I'm writing out my notes. I like to write out my notes as I think and as I process. Right. So now we have to process this information. Right. There's always an interpretation to be had. This does mean something. This right here. This does mean something. This probability. It does mean something. So, for one, we already know that the Fed does not want to rush lowering interest rates. We know that much, right? That's not our interpretation. We don't have to interpret that. They're telling us that, so we don't have to interpret that. That's another thing you want to keep in mind as well. If no interpretation is needed, don't throw your interpretation in there. That's pretty simple, right? If no interpretation is needed, don't throw your interpretation in there. All right. So they're already telling us why they're not going to lower interest rates. But from an interpretive perspective, I would say if this 1% probability does work out, let's say they do lower interest rates today. There was only a 1% chance of that, right? So in my opinion, there's there's likely to be some weakness in the economy that they see since these probabilities came out that's causing them to do this. All right. So there's a 99% chance of no rate change. If there's a rate change, it should be taken as a sign of underlying weakness. All right. Everybody understand that? Now, here's a here's a question. Right? Here's a question for you guys. So on the first of all, how many of you guys have been how many of you guys actually have been watching and paying attention to the Fed Watch tool, right? And then how many of you guys every once in a while, remember I told you guys, this very same page right here, if you come down on this page, right, you have where is it at here? Oh, there we go. Right? You have a lot of different things happening here. Like our economic data ahead, which we're about to take a listen to right now. Right? Yeah, don't forget I told you guys there's a lot of other stuff on this page. Specifically this section right here, yield insights from a market expert. Okay? Um, we love to get expert opinions and data, right? So let's take a look at this. And then our 10-year yield 10-year Treasury yields the new normal. We'll probably take a look at that as well. All right. By the way, look at this. They also have courses down here. Okay. Take self-guided courses. Okay. Check that out. Maybe we'll go through one of those courses together one of these days. Yeah. Y'all want to do that? Y'all want to go through one of those courses together? I'll do that with you guys.
Are concerns over a slowing economy driving bond yields lower? Well, back on January 14th, U.S. 10-year yields hit 4.8%.
Let's pause. Did you guys hear what he just said? He already confirmed something I just said. He said, "Are concerns driving yields lower?" What did I just say? If that rate, if they give us that 1% chance and they lower interest rates, as I said, that's going to be a sign of weakness. Watch this. Listen to him very carefully. Let's go back. Wait a minute. Did that audio come through? Did that audio come through? Yes. Just want to make sure that was clear. He came through clearly. Yeah. I figured so. All right, so it came through. All right, let's take a listen.
Are concerns over a slowing economy driving bond yields lower? Well, back on January 14th, U.S. 10-year yields hit 4.8%, a level not seen since late 2023. Now, at the time, rising inflation and a resilient economy were making bonds less appealing. But since then, yields have dropped sharply, reaching a cycle low of 4.16 on March 10th. The prevailing theory? Well, the market's starting to price in a slowing economy, maybe even a recession. The Atlanta Fed's GDP Now tracker supports this. It projected nearly 4% GDP growth in early February, only to plummet to a negative 2.8% reading by early March. The thinking goes that a weaker economy will shift investment away from riskier assets like stocks and crypto into the safety of U.S. Treasuries. Now, the new administration has not ruled out a recession in the near term as they roll out new policies, which has created additional market uncertainty. Now, in several interviews, including one just this past Sunday, March 10th, the president has hinted at a short-term pain to pave the way for long-term gain. Now, of course, this sell-off in yields ties closely to the belief that slowing demand will keep inflation from spiking. But there's a wild card here: tariffs. The market's grappling with the uncertainty over how they'll impact inflation, and that lack of clarity isn't helping at all. Now, on March 12th, we'll get the latest CPI reading. Expectations are for year-over-year figure of 2.9%, a slight dip from February's 3.0%. If that number surprises to the upside, it could shift focus away from economic weakness and put pressure on bond demand. Conversely, if that number confirms that inflation is slowing significantly, it could pave the way for lower yields. Now, if a trader believes that the yields could move lower from here, they could express that by selling the micro treasury 10-year yield futures contract at 4.25, targeting a move to the psychological level of 4.00. Now, a stop for this trade can be placed above at 4.35. This trade can make $250 if the target is reached and risks $100 if you're stopped out of your level. Now, if a trader believes that yields could rise from here, they could buy the March micro treasury 10-year yield futures contract at 4.25 and target a move back to the January highs of 4.75. Now, a stop for this trade can be placed below at 3.90. This trade can make $500 if the target is reached and risks $350 if you're stopped out of your level.
Sorry, that's me. I had it on mute for a second while the video was going on. My apologies. Uh, so so we're gonna go from we're gonna take a look at this real quick here, right? So here's what a lot of people aren't noticing, right? So from the highs of 2021 to where we are right now, you got about 17.5%, right? Got about 17.5%. Good morning. I believe Doja is Thea. Good morning, Thea. Hola, hola. I think I'm correct. Let me know if I'm right. uh, so yes. So we're about 17% off of the 17.5% off of the highs of 2021 right now. All right. Um, Now this from the lows of 2022 October all the way to the highs that we set this year. That's one solid move. Now we could take the lows of October and deal with that as well. Um, we'll do both. All right. So we're gonna come from here to here. Let's um let's invert this really quickly. All right. I'm gonna reverse that. Okay. If you reverse it, now you're up here. So would you look at that? All right. Um, I'm sorry. No, 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 no. I'm sorry. Let's undo that reverse. Actually, we are coming down this way. So either way, so your 50% retracement, 481, 56. For 50% retracement from this high, since this low, brings us back to the highs of 2021. How interesting is that? Hmm? You see, again, these are things that people may not be thinking about. They need to think about these things. All right, now watch this. Let's get deeper. All right, let's move it from here to here. I'm sorry, no, no, no. Click on this real quick. From here to here. All right. I'm not trying to be exact on the numbers there. All right. So 50% retracement brings us to 511-ish, somewhere around there. Okay. 61.8, 487. So either way you put it, all right. Let's move this around a little bit. If it's a 50% retracement, that's another 10% down, bear market. All right. If we take the 61.8% approach, it's another 15.6% down. Right, still in a bear market, not quite back to the highs of 2021, but the are people going to wake up and realize that much of what's happened since the lows of 2022 was not fueled by was not fueled by anything extremely you know there wasn't much of a catalyst to go to the lengths that we went to the extent that we went to. Okay, so people need to realize that, right? And this is why it's so easy to just rip these why it's so easy to just rip these valuations away from the market, right? We were talking about .com level valuations here. All right, we're talking about .com level valuations here. So I heard somebody say recently, yeah, it's not like we're looking at .com valuations. I was like, what? What are they looking at? Right? What exactly are they looking at to suggest that we're not looking at .com valuations? All right. Give me a second here. Let me 1 second here. Let's do something really quickly here. All right. This is the dot-com bubble, 44.19. This was us at some point in 2021 at 38.58. This was us just recently at 37.74. We're still at 35. All right. Um, if my memory serves me right, somewhere between 15 to 21, right? In this range is where we should be. Okay. Let's put us like around here. Right? At about let's call it, no, not here. I meant to say right about here. Pretty sure it's about 18. Okay. I would think we're pretty far off from the average, right? Um, so the average they have here is 17.72, right? I'm talking about the average that's associated with long-term financial growth, not the actual average. So I'm talking about the average associated with 5.5% GDP growth. That's what I'm talking about. The average associated with 5.5% GDP growth. Now, let's proceed here. All right, we'll come off of that. I'm actually gonna go back to the main page here. This is also one of my I'm just kind of walking you guys through some of my favorite things to look at in the mornings here, right? This the main page of Trading Economics. A lot of you guys probably don't visit this page. Wonderful resource. As you can see, I have all of my commodities here. Right. I've especially been looking out for lumber lately. We got to take a look at that one of these days. Let's see. Let's take a quick look. Yeah, it's off of the high is pretty decent. Off of the high is pretty decent. Um, little measurement here. It's off of the highs by about 10%. Little correction. But I've been noticing um, a lot of lumber companies have been changing hands. One of the firms that I own, Builders First Source, has been buying lumber companies left and right. I think I want to join that fight for a little while. Um, uh, we got steel, coal, copper's up on the look at copper. Hello, copper. Shine, why don't you? Shine, why don't you? Show 'em who the real metal is. Um, gasoline. How much y'all paying? How much are you guys paying per gallon out there right now? How much y'all paying per gallon out there right now? What are y'all paying per gallon out there right now? Let us know. Put it in the chat. What are y'all paying per gallon out there right now? Ooh, 318, huh? Somebody's paying a premium. We got crude oil at 66.78, 318, 319, and 285. Um, Alicia, you know, next time, oh Lord, Those of you too. I was gonna say next time. I was gonna say next time, y'all better wait till y'all see some more of these from some more of these numbers before you put those out. Somebody gonna come through and drive up y'all home prices. They coming where y'all at. They want them gas prices. Y'all home prices is going up right now. Somebody on the real estate site right now looking to come and see y'all. um so Fed is looking to keep rates solid where they at. Now let's look at some of these other things here that we're seeing. So mortgage rates rise for the first time in 9 weeks. We did see that. This is coming out 50 minutes ago. Euro area wage growth slows further in Q4. Biggest issue is slowing wage growth, and we have to see this, play out in the numbers later on. Biggest issue with slowing wage growth is you can't have you know you don't want productivity to slow with that, right? You want productivity to remain the same while wage growth slows. Okay. Because what's going to happen is if productivity slows down along with wage growth, at some point, wage growth always picks back up, right? At some point, it always picks back up. So when it does eventually pick back up, you don't want it to be on the back of lower productivity. Again, for those that aren't really aware, productivity, if I was to explain it in the simplest way, how much are you producing for what we pay you at your job? Put it in the simplest term, right? The Turkish lira is still getting killed, y'all. Turkish lira is still getting killed. Let's take a look at something real quick. TUR. You see this? This is the Turkey ETF fund right here. Let's take a look at that real quick. All right. Um, in 2024, I actually bought the Turkish ETF, right? And I took it a good amount of the ways up here. I didn't take it all the way to $44. I got rid of it around 40, if I'm not mistaken. I bought it somewhere down here, early 2024, and took it out to about $40. I see they continued on for about another 10%, but I was satisfied with that gain. Um, what do you got there? About 18, percent. Once I saw it was above 15%, I decided to go on and get on out of there. Iceland lowered interest rates again as well. Mm, 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 mm. The other thing about these nations lowering interest rates before we do. The other thing here is that um, as you can see here, we have one, two, three out of these nations here that they have listed. Only three of them have higher interest rates than we do. One, two, three, four. Four of them have higher interest rates than we do. Right, and here goes Iceland right here. I thought I just saw them. Oh no, that was somebody else I saw. Okay, but yeah, so only four of them have higher interest rates than we do, and you can see how much higher, right? So you can tell that these interest rates are not high because they're not high because of inflation necessarily. Not all of them, right? You know, the a lot of these are just riskier bets, right? I mean, this is at 3.6 to our 2.8. Does it really need to be this much higher than our interest rates, right? Not necessarily, right? This one is 5.06 to our 2.8. Does it necessarily need to be this high? So you can tell that a lot of this is because of the risk that's being taken, right? And somebody was trying to fluff up Russia's economy the other day. Um, you guys weren't there, but they're like, "Oh, Russia's not doing that bad," right? And I'm like, "Okay, buddy," you know. But yeah, so you have 10% inflation and 21% interest rates going on in Russia right now. Um, Ouch. That's all I can say. That's all I can say is ouch. All right. But look at this 3.77 to 9.5. So a lot of these interest rates are so high because of the risk, right? But like, you know, in a lot of these cases, like Japan could be the one area where they like to say they go and they borrow money at this low interest rate to invest here, you know. Maybe here if they feel like, maybe in some of these other places, if they feel like taking the risk. But the key point remains that, when it's all said and done, many of these uh, many of these economies, let's say they did go and borrow that money from Japan at a low interest rates. Well, where's a lot of that money going to land, right? Where's a lot of that money going to land? That's the big question, and it's going to be very hard for them to get that money over the United States. That's one of the big things to think about. All right, let's take a look at the whole market here, the broader market here for a second. Let's take a look at it, and then we'll take a look at a few things from here. Let's go to finviz.com here. We'll walk through some things with you guys. All right. So as we can see, we're still on the low end here with our indexes. We're still on the low end. Now, with the SPY being this low on the RSI, let's see what things can, so it looks like as of right now, cyclicals may be the only thing of interest at the moment, right? Everything else, look at where everything else is, right? Right? It looks like cyclicals may be the only thing of interest right now. Um, so, um, so how do we discern weakness versus risk easing when countries lower rates? Um, you wanna first of all you wanna read into the notes that because we're not paying attention to those countries a lot. So you actually want to read into the notes. That's one of the first things you want to do. You can take a look at their rate of inflation. If they have already seen inflation fall dramatically, right? Then there can be some reasons for lowering interest rates, but how low are the interest rates is the question, right? If I still have inflation at 5.5%, do I want to have my interest rates already at 2.5%? Probably not, right? So that can be some signs of weakness is when interest rates are to a point where they're so low it doesn't make any sense. Like some nations are used to having higher inflation because that's just the nature of their economy, right? They naturally have these weaker economies. You understand what I'm saying? That they naturally have these weaker economies with higher inflation rates. So it's yeah, it's something to think about there. So some of these guys, when you see inflation as high as it was, or high as it is right now, you might imagine that they already had pretty high inflation rates before now. Okay, so just think about that. Now, so back to this right here. So so we got SPY at 37.95 on the RSI. What I would be looking for is sectors that are actually still below 30. That's what I'd be looking for. Sectors that are still below 30. All right. And right now, only cyclicals is in that place. So if you're thinking I want to keep making purchases here, right? We would we would look at cyclicals and maybe the next lowest up, which would be communications, right? But as you can see, cyclicals, communications, tech are the three hardest hit right now. So I would go in that order if I wanted to focus on anything right now. Like, is there anything I want to buy right now? I'll go in that order. I'm thinking about showing you guys a little trick that I wrote into my book. A little trick that I didn't teach you guys this morning, that I didn't teach you guys yet about filtering out. The question is, do you guys deserve a treat for being the only ones that popped in this morning? Hmm. Yes, no, yes, no. Should we show a little you know Cece, I'm gonna use Zachary's word. Should we show a little latitude, uh since you uh since you guys popped in this morning? What y'all think? What do y'all think? Should I give y'all a little peep of the book? We giving rolling eyes emojis? Is what we're doing? All right, they rolling their eyes at me, y'all. That means no tricks for y'all. All right, so let's do it then. I'll show you guys. So this is one filter that I've never talked about. This is one filter that I've never talked about that I wrote into this latest book that I'm writing. Um, the fundamentals of technical. I'm sorry, the fundamentals of value investing. The fundamentals of technical analysis is coming next. So yes, so the fundamentals of value investing, latest book that I'm writing right now. Um, I'm going to show you guys a filter that can be very helpful. All right, and that is the analyst recommendation filter. The analyst recommendation filter. All right. So what we like to do here, right, is in moments that we're in right now, in moments of weakness, we like to go ahead and make sure we're going for the buy or better, right? We go for the buy or better. You see what just happened? You guys see how many companies just disappeared? All right. Now we're also looking for cyclicals, right? So let's take a peek here, right? So if I go for any 573 companies, if I go for buy or better, 354. So over 220 companies, or we would say almost 20%, 20% of the cyclical sector is rated below a buy right now. So we don't even have to deal with those guys. All right. On the fundamental side, let's see how many pages we got here. We know we like to you know like to keep this down to 4 or 5 pages. All right. And we'll talk about why in a second. Let's see here. Let's go with we also let's so in a moment like this, imagine this, right? quartile, Anisha, quartile. Yeah, quartile. But great job, though. Great job. Great job. You're still on point. You're still on point. Quadrant is still pretty much the same thing. So, so great job. So, so imagine this, right? Imagine this. I want you guys to imagine that we're looking at companies that were rated a buy or better, that the insiders at the companies are also buying. And look at that. We're down to 57 companies just like that. All right. So we only got 3 companies left. So if we're down to 3 instead of 4 or 5, 3 pages I meant to say, then smack in the middle here, we would have to consider this growth at a reasonable price. Right? Let's sort this out by let's sort these guys out by let's keep it simple and sort them out by price to earnings. All right. And let's go in descending order. If we go in descending order, then we know that this first page that we're on right here would be considered growth. The second page, third page would be considered value. Second page would be considered growth at a reasonable price. If we only down to 3 pages, we have to go with the middle page here. We have no choice. All right. I want y'all to keep that in mind. If ever that happens to you, you have no choice. Go with the page in the middle. Right? So these would be the only companies we'd be interested in researching here at the moment. Right? Now, don't get me wrong. Right? Don't get me wrong. We love the fact that, of what we're looking at. These are all buy rated companies. We love that. All right. But the issue here is let's go to the evaluations. Right? They're sorted out by price to earnings. All right. Let's take a look here. Right, as you can see at the high end here, 158, 21. These aren't that bad right here. These aren't that bad right here. Well, I guess you could. Oh, now you could split this. You got 57 companies. You could split this into 5 anyway. So you would say, what would that be? So any from 1 through 50, split it into 5. So this first 10, you would say, is a no-no. This first 10 right here is a no. Then 11 through 20 would be considered growth. Right? 11 through 20 would be considered growth. 21 through 30 would be growth at a reasonable price. All right. So 21 through 20 would be for sure, right? 31 through 40 would be considered value. And then all of these guys over here would be considered cheap for a reason. All these guys are cheap for a reason. Oh, look at this guy. We know they cheap for a reason. These guys work in textiles. All right. I'm sure they're not looking to invest in textiles right now. Wait. What did I see? DSS? Who was DSS? Oh, okay, that's the packaging company. Look, you can look at the stocks chart as I pull it up to see that nothing's happening with these guys here. All right, so again, 1 through 10 would be marked off as essentially we're just too high, right? So we ended up with 57 companies. We're going to mark it 1 through 50 as the guys we're looking at, right? So either you look at these 3 pages and say I'm going with number 2, or you split these 50 stocks into 5, which gives you the quintile, right? So you have quartiles, you have quintiles, all right? We're gonna go with the quintile approach here. So we're splitting it into groups of 5. So these 10 up here, we're gonna say these guys are the ones that are too expensive in this group. This other 10 would be considered our growth prospects, which is interesting. I'm seeing some names here like Grief Shipping, right? This is another packaging name. All right. These guys, matter of fact, let's take a quick look at these guys here. I want to show you guys something. Let's go over to their website real quick. All right. All righty. Notice how I gave access to cookies, but I blocked my location. Stay woke, guys. Stay woke. They can have all the cookies they want. All right, drop them cookies down. We good. You know, they can track where I'm headed, but they can't track where I'm coming from. You always got to pay attention to that, right? So you see what these guys do here, right? They're so when they say packaging, this is what they're talking about. Packaging. So you see these little, you can identify a lot of different products that these guys deal with. Look at the packaging products here. Drums, right? You got drums. You got you know, flyboard. You know, fly paper. You know, you got look at those big boxes you see the watermelon in at the grocery store. Y'all always see those big boxes at the grocery store. Look at them right here. These are big drums for transporting chemicals and other stuff like that. So you can kind of see the kind of packaging they deal with, right? Now I'm not going to get too deep into this company today, but what I'm getting at is one of the first things you want to do is learn as much as you can about the company that you're dealing with, right? These guys are pretty well off of their highs. Um, let's see, what's the projected growth here? Y'all want to learn a little formula? Um, I can go 2 for 2 giving y'all something out in the book. I got a formula in the book that I haven't that we haven't gone through in a while. So intrinsic value, so IV equals the earnings per share times plus 2 times the growth plus 8.5. Now, why 8.5? 8.5. I'm gonna put it in the chat for you guys right now. Right. So the intrinsic value equals the earnings per share. So you can see how it's written. Earnings per share times 8.5 plus 2G is how they write it. I'm putting it in the chat right now. That's how it looks right there. Right? So why 8.5? Let's talk about that. Why 8.5? So the reason for 8.5 is because, get this, guys, 8.5. So anytime I see a company with a PE ratio right here, you see the PE ratio right here? Anytime I see a company with a PE ratio of 8.5, that would mean that the market, the stock market itself, does not believe the company will grow. Isn't that interesting? If they have a PE ratio of 8.5, the stock market is saying they don't believe the company is going to, has any growth opportunities in the future. Anything below 8.5 says that they believe the company is actually, on a decline. All right. Now, a company can be mispriced. Company can be mispriced. So we look into that. All right. But this PE ratio right here should be equal to the formula that I put in the chat. So let's take a look, shall we? So where's the projected growth at? So we don't have any projected growth right here. All right. All we have is past growth. right here. That's all we have is past growth right here. Now, there's a such thing as what they call the sustainable growth rate. So what I would do is I would take this return on investment of 4.32%, and I would multiply it by the payout ratio here. Right? So it would be 1 times 3.82, or I'm sorry, minus 3.82%. We'll just call it about what's that? 96%. Let's call it about 96%, right? To keep it simple. So 96 times 0.0432, that's our 4.32%, right? So we would basically say our growth rate is about 4.15%. So even if they don't give us a growth rate, I multiply this number right here, your return on investment. I multiply that by 1 minus this dividend yield, which is my payout. So I basically multiply this by my payout ratio. I multiply the return on investment by my payout ratio. I think the payout ratio is somewhere on this page. At least it used to be. Oh, there it is. Good morning, good morning, good morning. Everybody that's just joining. Later, Cecily. Okay, so this is the payout ratio here, actually. This is the payout ratio here. So my apologies, I did that wrong. The payout ratio is more like 45.29 times 0.0432. So no, so the sustainable growth rate is actually more like 1.96%. 1.96%. Yes, I will be uploading it to YouTube when we're done, Alicia. I have a recording. I will upload it to YouTube when we're done. All right? So you guys can look forward to that. It will be uploaded to YouTube when we're done, and I'll post it in the chat. All right? Once it's uploaded. All right, now, no problemo. But again, welcome everybody that's just chiming in. So 1.956%. So if you look at the formula in the chat, look at the formula that's in the chat right now. All right. So 8.5 times 2, plus 2 times the growth rate. If our growth rate is 1.956, so times 2, so we get 3.91. We get 3.91, right? So 8.5 plus 3.91 equals 12.41. 12.41. We multiply it by our earnings per share, all right? Times 3.5, and I get 43.5 is so I call that the maximum price to earnings. That's the maximum price to earnings we can have. Okay, so the maximum price to earnings is 43.44. We can see the well off of that right now. They're at 16, right? So they're trading at an extremely low valuation compared to what they could be trading at. All right. So watch this, guys. Watch this. So here's the deal. So we take this price to earnings right here. All right. I'm sorry. No, I'm sorry. I'm sorry. That's. I'm sorry. This is their intrinsic value. I meant to say 43. Not the max PE. Their max PE was I'm sorry. I'm sorry. The max PE was 12.41. I meant to say that was their max PE. Um, and their intrinsic value, I meant to say, is 43.44. I meant to say. All right. So my apologies on that, guys. So now here's the deal. All right. So they're trading at 55.95, which means we would actually want to see some more downside in the stock. We know that forward PE is non-existent. So we don't have any growth rate expectations for them. All right. We know they're trading at a pretty low price to sales and so on and so forth. So right now, we would still be looking for some downside in this stock. Look at the latest earnings surprise anyway, 46.64%. Right? Let's see when the last time it was they were trading at 43.44. Let's go take a look real quick. When was the last time they were trading at that price? Let's go to the weekly chart. Okay. 43, 44. We're just gonna go to 43 bucks, somewhere around there. Go right here. That's close enough. So right around here. And what's crazy is if you look at this price, look at this price action right here. You might argue that they look like they might be headed in that direction. Yeah, they look like they might be headed in this direction. If you ask me, if you ask me, they look like they might be headed in this direction. All right, so about $43.44. All right. So at this moment, we don't want to pay more than 12 times earnings, just about, right? We can do 13 if you want to give them a bump, right? We don't want to pay more than 13 times earnings, basically, right? So if we did 3.5 times 13, you get $45 just about. All right, so we can move this up to 45 bucks and keep it simple. All right. So and look at this. Look right here. Right? See that previous area consolidation happening right here? Right? Let's grab our anchored volume profile. And let's go since the low of 2020. Right? Since the lowest point of 2020, what's been the average price paid? Let's grab our anchored volume profile here. We go from here. So we're already trading below the point of control. Right? We're already trading below the point of control. So since 2020, average price paid for this stock, or most agreed upon price, is around $61.77. That was the average price paid for this stock. All right. We're looking for about 45. If it goes from 45 back up to, let's call it 62, that's going to be about a 37.8% gain. Plus the dividend. Plus the dividend. And you can see, look at this. You can see the little high volume area right here, little tiny high volume area in the air in the range that we're looking for, right? And we also know that there was a lot of buying down here, a little bit lower at about 35. But what we end up doing for ourselves is avoiding this right here, from here to here at least. We at least end up avoiding this, right? Now, of course, this is our intrinsic value. So what we want to do when it comes down to intrinsic value is we want to buy below this price. So this is our intrinsic value. Let's mark this off. So our intrinsic value. Let's put this let's put this right here. So that's our intrinsic value right there. All right, we haven't discounted it yet. 45 divided by 1.18, let's say. And get this, right? Y'all ready for this? It puts us right around here. 38 bucks. Right around here. Let's put that right around 38. It's our discount. Okay? So when you figure out your intrinsic value, when you use that formula in the chat, right? You want to buy below that value. That's your margin of safety. So this right here becomes your margin of safety. Okay? That becomes your margin of safety right there. That's how that works. Now peep this, guys. All right. Let's see here. Show you guys something real quick. All right. So this is what I'm trying to tell you guys right here. See this? This is your intrinsic value, your margin of safety, where you buy. Your intrinsic value, your margin of safety, where you buy. So once you calculate the intrinsic value, then from there you determine where you want to purchase at. All right. And there's no example. There's no example that's going to show you anything different. All right. All these examples are going to show you the same thing. All right. Intrinsic value, margin of safety, buy. All right. Now you don't have to sell up here, but you know, they're trying to make a point. All right. Uh so yeah, so that's the premise, right? That's the premise. That's what we're looking for. All right. So there's another way to look at this as well. So here's what we do. Over here on FinViz, you have the where's it at? Where's it at? Where's it at? Here we go. So here's the average analyst target, which is pretty interesting. It's around $76.83. Right? $76.83. Let's discount that as well. So one of the things that you don't want to do in investing is have a bias towards your own thought process. You don't want to have a bias towards your own thought process. So what do, right? So if we have the intrinsic value of 45 discounted, we have 38 bucks. All right. They have the stock value at 70, we call it $77. We discounted at 65. So what do? You take the average of the discounts and the average of the targets, right? And see what happens. So 45 plus 77, 122. So the average target is about 61 bucks. Okay. Margin of safety, I do 18%, $51. Well, it's actually $52. Where are we right now? We're still too high. Okay. So if we were to take the average analyst target into consideration, then this would be more like $61, like I said. So 61. So that's our intrinsic value. All right, let's move this over here now. I'm gonna move this to the right. This becomes our intrinsic value here. So you know that's crazy. I'm just realizing something. Our intrinsic value just became right where the point of y'all see that? How crazy is that, y'all? It just became right where the point of control is. That's crazy. Well, it's not crazy because I mean, if you guys have been working with me for a while, you already know that's actually not crazy, right? It makes a lot of sense, right? And then our discount is about $52. I'm sorry, hold up. Let's move this to the right. So discount's about 52 bucks. So we still need to see them fall into this area here. All right. So once they fall into this area, all right, then it becomes more of a buy. All right. Once they fall into this area, then it becomes more of a buy right there. Okay. So, and this is your value area low right here. This is your value area low right here. See that dashed red line there? That's your value area low. This dashed red line is your value area high. So this is where, if we talk about the anchored volume profile, right? This is where 85% of the volume is. All right. So, as I was saying, my apologies there. So as I was saying, this becomes this is your value area low, this is your value area high. Your value area is where 85% of your volume is. Okay? So 85% of the buying and selling happen between this price and this price. Right? Now notice your average analyst target is all the way up here. Right? So if we were to think about it, then the average analyst is telling us, this is what the stock is worth here. Right? So so then in that regard, the um the intrinsic value that we find down here, you got to think about that, right? Like it's really helping us to to understand that you know we need to develop our own thought process around intrinsic value, right? We just have to. Okay. Because if we go based on what the average analyst thinks it's worth, then anything between here and here, or here and where we are right now, could have been a buying opportunity, right? But once we calculate our own intrinsic value, realize that yes, this is most certainly a better way to look at the market. All right. So take that with you guys throughout the day. We're gonna discount these. We're gonna discount. I'm sorry, 1 second, guys. All right, sorry about that. Yeah, so take that with you throughout the day. By the way, look at where we are in the pre-market. Actually, right? We're at 55.68, right? So we're actually, already, trading below the price that we closed at yesterday. But again, we're looking for more closer to $52 per share. So, just kind of highlighting that. Now we haven't actually graded the company yet. So let's take a look. Let's take a look, right? Let's go to stock analysis real quick. And let's see if this company meets the grade to begin with, right? I'm just showing you guys that, you know, um, because it's an important part of the process, right? Let's see here. Let's see here. Let's see. All right, so our financial position shows a really nice current ratio, but our quick ratio is trading below 0.7, around 0.74, below 1, which shows that we probably got a lot of inventory built up. Again, these are the reasons we want a margin of safety because, valuations are, you know, um, valuations are going to be, like they're just going to be maybe a little over the top for what the company may be valued at the moment, right? So our debt to equity at around 1.42, debt to EBITDA 3.83, but look at our debt to free cash flow, right? At a 21.1, 21.12, right? So that's not what we're looking for. All right, we want a debt to free cash flow more like in the 7 range, which shows that we don't have more than 7 years of debt stacked up on our free cash flow here. All right, earnings per share $4.43. Free cash flow per share $3.14. All right, so let's see. That looks decent though. We're gonna find out though. It's about 73% free cash flow to earnings. So that shows that they do have quality earnings, and you kind of assume that based on the kind of company it is and what they do, that they are going to have quality earnings unless they're just a very very new company and haven't built up a client base yet, right? But these are the types of companies that have a client base that is going to be very consistent, very constant. All right. Let's see what else we got going on here. Mm, our Altman's here at a 2.07 shows we're in the gray zone. We're in the gray zone. We're not necessarily in any type of distress, but we're in the gray zone here. All right. Let's see here. Return on capital is about an 8.3. Return on invested capital, 5.5. Not quite what we're looking for here either. All right. Free cash flow margin is relatively low. So, I'm looking at a company that so far, I would most certainly, so they're profitable. They're profitable. They're doing well in that regard. Their payout ratio is middle of the park, which means that they're not throwing all their earnings into dividends. So they are holding back some type of earnings towards believe they're going to grow a little bit here, right? But and they have 4 years of dividend growth under their belt for right now. But we're looking at a company we probably do want that greater margin of safety based on what we're seeing here, right? So we might want to discount it further. That's kind of how you look at this stuff, like you just might want to discount it a little bit further because you're just uncertain about what you're seeing here, right? So maybe down towards that original intrinsic value, would still be what's best, close to that $45 that we had around here would still be what's best here, and we're gonna come back and look at this company one of these days. All right. But for now, market's about to open in 10 minutes. I'm gonna go ahead and shut down for now. But I hope you guys enjoyed the morning session, picked up on a few things. I'll catch you guys. That'll be on Clubhouse a little later on in the day. Catch you guys over there. Other than that, everybody be blessed. Stay well. Does anybody have any questions before we close out? Anyone? Any questions before we close out? Anyone? 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 Give you guys a second. I know you got to type in there just in case. All right. So, like I said, for those, matter of fact, if you have any questions, feel free to join us on Clubhouse later. You can pull up to the equity channel. I'm going to share the link in the chat right now um, for you guys. 1 second here. Mm. Actually, well, I'm gonna share the link to my profile in the chat because it's making it a little difficult to grab the link for the house there. So yeah, so if you feel like it, join us on Clubhouse. That is a terrible link. All right, but hey, that's the link. Um, but anyways, I'll catch up with you guys later. Everybody be blessed. Stay well. Talk to y'all soon. Later.